In our last video, we have seen how we can ensure a long position by purchasing a put option. In this video, we are going to see how we can ensure short position. Let's see. So, what is a short position? A short position can be explained in two ways. First, selling a stock by short selling, and selling a stock today provided that currently we have a stock. Now, what is a short selling? Suppose Mr. X is a businessman. He assumes that the price of apples will fall in 6 months' time. Currently, he has neither money nor the apples, but he has a friend, Mr. Y, who has lots of apples. So Mr. X borrows an apple from his friend Y and makes a promise that he would give back this apple exactly after 6 months. So Mr. X sells that apple for $2 in the open market and invests this money in a risk-free investment. Thus, trading something without owning is known as short selling. And after selling the apple, Mr. X is in short position. So after 6 months, if the price of apples really falls, say 1.5 per piece of apples, then Mr. X can buy an apple from the open market for $1.5 and give it back to his friend Y. So what we see in this case, Mr. X's profit is $0.5 plus the interest earned during this period. However, if the price increases after 6 months, say $2.5 per piece of apple, then Mr. X is in danger. He would make a loss of $0.5 plus interest earned during this period. Let's discuss a different situation. Suppose currently we have a stock of price $100. Somehow we knew that the price of the stock is going to be fallen in 6 months' time. So what we will do? We will sell the stock and invest the money in the risk-free investment to grow our assets. So if the price of the stock really falls in 6 months' time, say $90, then we would be very happy, and we will make a profit of $10 plus interest. However, if the price of the stock increases in 6 months' time, say $120, then we will regret saying if we hold the stock, then we could have made more money. Oh, that's very frustrating. In both cases, we are in short position, which affects negatively when the price of the stock increases in future. So how to protect that situation? To protect ourselves in short position, we need to buy a call option, which is known as caps. So what is a call option? Well, a call option is a contract where the buyer of a call option has the right to purchase the stock at a price K that had been set at the beginning, like at the time t equals to 0. Now, if the price goes above that price at the end of the period, the buyer of the option will buy the stock from the seller of the option. So if the price goes below the set price, the buyer of the call option does not exercise the option. Instead, he buys the stock from the open market. Therefore, for the buyer of a call option, the payoff from the call option at the end of the term is defined as maximum of the difference of the stock price and the strike price, that is ST negative K, or 0, where K is the strike price that is defined at the beginning of the term, and ST is the price at time t, also known as the spot price. So what is the benefit of the seller of the call option? This guy is giving you a big opportunity, so he should have some opportunity or profit. So the seller, also known as the writer of the call option, receives a smaller amount of money at the beginning of the term, which is known as the premium or price of the call option. So therefore, for the seller of a call option, the payoff from the call option at the end of the term is defined as just the opposite of the buyer of the call option, that is negative ST minus K, maximum of ST minus K, or 0, where K is the strike price and ST is the spot price at time t. So that's the graph. Where the bottom line is the stock price. If we can see, if the stock price increases at after 6 months time, the payoff from the stock decreases linearly. Now this is the graph of the option payoff. We can see if the stock price up to $100, then we do not exercise the call option. When the stock price increases, we can see the payoff from the option increases linearly. So that's the total payoff when we buy or exercise a call option. So the minimum payoff that we can have at time 6, at time t equals to 6 months, minimum payoff is $100. So that's the profit curve without buying a call option. So we can see if the price is less than the strike price, I mean $80, we are in profit. It's a positive value, $20, near about $20. But we can see when the price increases, like price $120, the loss is more than $20. So this is the curve of profit when we apply a call option when we are in short position. So we can see that if the price increases above 100, our loss is minimized. That's how caps work. Now let's see how this work in for an example, like using Excel. Suppose the current stock price is $100 and interest over 6 months period is 2%, and the buying price of the call option is $5.4, and the strike price is same as the current price is $100. So we will consider 11 different cases at time t equal to 0 and at time t equals to 6 months time. So stock price $100 and buying price negative $5.4. We are putting negative because we are paying this money, and we are getting this $100 by selling our product, whether it from short selling or just directly selling. Okay, so what is the value at time t equals to 0? We have $100 positive and $5.4 negative, so total value at time t equals to 0, $94.6. Now we're gonna calculate or consider 11 different cases at time t equals to 6. So what is the accumulated value of our initial assets if we have invested that amount in risk-free investment? What we will do, we will just calculate the accumulated value using this formula. The value at time t equals 0 times 1.02. So that's the amount that we will have after 6 months time. So let's consider 11 different cases when we consider the stock price starts from 75 to 125. So what is the payoff from the stock at time t equals to 6? This is negative of the stock price. This is negative because we have to buy the stock to pay our friend or just to have the stock. Okay, so what is the payoff? These are the payoffs. So will we exercise the call option? Let's find this using this formula. If the stock price is less than the strike price, then we will not exercise the call option, otherwise yes. And what is the payoff from the call option? As we defined, the payoff for the buyer's perspective, the payoff is defined as maximum of ST negative K. So this is ST negative K, this is our K, that means the strike price, or 0. So that's the payoff from the call option. what is the total payoff? This is the payoff from the stock plus the payoff from the stock. That's the total payoff. We can see the payoff remains constant when the price increases above 100. So now let's consider the profit. Consider we didn't buy the call option at the beginning of the term. Then our profit would be the accumulated value plus the payoff at time t equals to 6. So that's the payoff, that's the profit without buying the call option. So we can see that if the price decreases, then we are very good, we have a great profit. But when the price increases, we have a great loss too. So to minimize this loss, we apply the call option. Let's see. So that's our accumulated value, that's our payoff from the stock, and this is our payoff from the call option. You can see when the stock price is less than the strike price, we are in profit. But when the spot price above the strike price, still we are in loss, but the amount of loss is less than that we have previously. So to sketch this whole matter, I prefer SPSS. Let's sketch this whole thing. So this is the stock price, ST, and then payoff from the stock payoff, option payoff, total payoff, and profit with and without buying the call option. So to use these values, we use the chart builder, the SPSS. From here we select the line and simple line. So ST, the stock price, will be in the x-axis, and we will consider each of the individual values in the y-axis. So that's the graph that we have seen in our slides. So we can see that the payoff decreases whenever the stock price increases. Again, chart builder, we just change this value, option payoff. We see this is the graph that we had previously. Again, chart builder, we'll change this one, total payoff, we'll drag this here. So this is the graph of the total payoff. Graphs, we'll change this one, and profit without the call option. So it's almost same when we didn't buy the call option, like this graph. So profit linearly decreases when the stock price increases, but we can control it just buying a call option. So profit with a call option applied, this is what it is. So price linearly decreases up to certain price, of a certain spot price like 100, which was our strike price. Now above the strike price, if the spot price increases, our loss is minimized. This is -5 and this is 0, so our loss is minimized. I hope this helps. At the end of the video, I would like to say I'm a student, lifelong student. I always try to learn some different things, and I might be wrong somewhere. So if I'm wrong, just let me know. I always appreciate any constructive criticism, and I make my videos for my friends to help them. So again, if it is helpful for you, then that would be great for me. Thank you.